Let's turn to Sam Coffin now for more analysis of the jobs report. He's senior economist at UBS. Good to see you. Thanks for joining us tonight.
Hi, thanks for having me.
Let me ask you this. This slowdown in job growth, how much do you attribute it to the trade war? How much of it is just simply the business cycle?
We think it's really an effect of the trade war. We saw real slowing in manufacturing late last year as tariffs interrupted the supply chain that manufacturers rely on. We think that's happening again now. And while what we've been expecting is to see the effects of the current round of tariffs would be to slow growth to near recession early next year. It looks like that's happening a little sooner than we expected and maybe a little more severely.
So where does that put the Fed? Are you in the camp that we see just one more rate cut, or given what you just laid out, would it be more than that?
We think they're on the way to cutting to a 1% funds rate. Today, after the payroll report and after the weak business surveys from earlier in the week, we cut our Fed funds rate forecast for October. We think they'll cut in October and continue cutting through the first half of next year.
So if the problem is mainly the trade war, the negotiations with China begin again next week. What if we get a trade deal at some point here in the near future?
Yeah, it could help a little bit, but a lot of the softening is already in train. The manufacturing sector has been under strain for a long time. They've been laying people off. The energy sector is laying people off, and rig counts are falling. Retail has been weak for a long time, and just the hit to confidence from the trade war and the uncertainty around it and the actual physical effects of restricted imports have had a real effect on those sectors.
So we're at the point of no return, in your view?
Not no return, but it's we're unlikely to see a real acceleration from here until after some of the current strains are worked out, and they don't just go away with some relentment on the December tariffs, for example.
Which has led you to cut your forecast for GDP growth.
Yeah, a little bit. So we've been expecting almost a recession early next year, 0.4% growth in the first half of next year. Today we trimmed our fourth quarter numbers a little bit. The auto sector, obviously the strikes are going to have an effect there, and because the deceleration in payrolls has been sharper than we expected.
Sam Coffin with UBS. Again, thanks for joining us tonight, Sam.
Thank you.